In this video, I am analyzing companies which are into chemical sector, and these companies are majorly in agriculture chemicals. Current market price of UPL is 943 rupees, and we are comparing UPL with other group companies like Gujarat Alkalies, Rallis India, Dhanuka Agritech and Meghmani Organics. UPL is down from its 52 weeks high by 9.7%. Gujarat Alkalies shares have fallen by 18% from its 52 weeks high. Rallis India's price has fallen 32% from its 52 weeks high. Dhanuka's shares have fallen at the rate of 29% from its 52 weeks high. That is the price which was way back 52 weeks. Meghmani Organics price has fallen by 34% from its 52 weeks back, or we can even say that would roughly translate to 1 year. So we see the more the fall, the weaker the stock, and lesser the fall, the more strength that particular company has. Let us look at the earnings per share of the last 12 months or the last 4 quarters. This is the profit that the company has earned behind every share or for every share. UPL's per share profit was 28 rupees. Gujarat Alkali has earned 93 rupees, and so on for the other 3 companies. But the earnings per share as a standalone value would not convey any sense in the number itself. So we have to use earnings yield, which will compare the profit per share with the price. That is, on the price that we are paying, how much is the profit that the company has earned in the last 4 quarters. UPL has earned 3% on the price of 943 rupees. Gujarat Alkali has earned 17% on the price, that is on 528 rupees. Company has earned 93 rupees per share. That translates to 17% of yield. Rallis India had 5.5% of earnings yield. Dhanuka Sugar has earned 5.2% on its share costing 436 rupees, and Meghmani Organics has earned 15% return on the share price costing 64 rupees. The profit per share was 9 rupee 8 paise. That roughly translates to 15%. Now we'll look at the valuation matrix from here on. First we'll look at the price to earnings ratio. This ratio measures where the price is in terms of the company's earnings. So what we see here is 33 times, meaning the price was 33 times higher than the price. Here we can visually look at the earnings per share was 28 rupees, whereas the price was 943, which means the earnings or the price was 33 times higher than the earnings. So 28 into 33 is 943, meaning the price was 33 times more than the earnings of the company. In other way, the way to understand this is that it will take us 33 years at the current rate of earnings per share to recover our capital of 943 rupees. Gujarat Alkali's recent price earning is at 5.6 years, meaning, or we can also say the price is 5 times higher than the earnings. The earnings was 93 and the price was 528. So we see the price earnings ratio is very good at 5.6 times. That is, price was higher by just 5 times more than the earnings. Here we want the ratio to be below 25 times and as low as possible. Rallis India was trading at 18 times its earnings. Dhanuka's price was 18 times higher than its earnings, and Meghmani's price was just 6 times higher than its earnings. So the lower the price earning, the better it is. It also means that we are buying the shares at a very low price compared to the earnings of the company. Next, let us understand how the PE was, or price earning was, in the last year. UPL's last year's price earning was 23 times, whereas the latest is 33 times, meaning the price has moved up, or the price earnings has become more expensive, or in other words, the price of the share has become more expensive. Gujarat Alkali last year was trading 7 times higher than the earnings, and now it is trading at 5.6 times, so it is below last year's price earning multiple, which is a good sign. Rallis India's PE is the same because we have the latest data of 2019. Rest of the company's data is up till the 12 trailing months. That is, we do have the 2019 values, but most of these ratios are considering 2018 values. Dhanuka's price last year was 16 times higher than its earnings, and in the latest 12 months it has increased by 2 points. Meghmani's last year's price earning was 9.5 and now it is 6.5. So it has improved, meaning we are getting it much cheaper this year than what it was last year. Let us look at the 5 years historical price earning, meaning how on average the company's PE was trading at. UPL's price over an average 5 years period was 16 times higher than its earnings. So we can see even last year it was above the average, means it is expensive, and in the recent 12 months it has become more expensive. In 3 years, that is last 3 years historical price earning, it was at 21 times. So basically what it is showing is that the price earning multiple is increasing. That is, the gap between the price and the earnings is increasing. Gujarat Alkalies 5 and 3 years price earning multiple was just 6 times, and the last year's price earning is 7.2 times, and the latest price earning is 5.6 times. So you are getting it cheaper and cheaper. Rallis India's 5 years historical price earning was 23 times, and 3 years price earning was 22 times. So we are of course getting it much cheaper now at 18 times. Dhanuka's historical price earning was 18 and 21 times, and the recent 2 years, or recent last 2 years, we are getting it much below the averages. Same is the case for Meghmani, where its 5 years historically price earning was at 9 times, and last year also it was somewhere around that only, and the recent 12 months the price earnings has fallen to 6.5. Either the price has fallen or the earnings has increased for the price to earnings to come down. Next, let us look at the price to OCF, or the price to operating cash flow ratio. This ratio basically measures how much has the company earned in terms of cash and comparing that with the price per share. The difference between OCF and price earning is that OCF considers only the cash inflows and outflows in its calculation from operating activities, whereas earnings or price earnings considers all expenses and all incomes from all activities of the business. UPL's price to cash was 16 times, Here we want the price to cash to be as low as possible and even below the price to earnings, which signifies that the company has been converting most of its profit into cash. Gujarat Alkali price to OCF or price to cash flow is just 7 times, which is very near to its price earning multiples of 5.6 times. Rallis India's price to OCF was very high at 34 times. We want the price to OCF also to be below 25 times at least. Dhanuka's price to cash was 14 times, meaning price was 14 times higher than what the company has earned as cash per share through its operating activity. Meghmani's price to OCF is very good at 4 times. So we want a value which is as low as possible, which indicates that the price is very near to what the company's shares is earning in terms of cash. Next we'll look at price to free cash flow. This is the cash which is finally there with the company as free cash, which can be utilized in the financing activity of the business. Like the price to OCF ratio, we want the price to free cash flow also to be below 25 times. This ratio too, if it's as low as possible, would be the best option for investors. UPL, in terms of free cash flow, the price was trading at 33 times of its free cash flow. Now this free cash flow is calculated by removing out investments in fixed assets that the company does out of its cash earnings of the operations. It is very important for investors to understand the OCF and the free cash flow. Unlike earnings which can be manipulated, cash flow and free cash flow is very difficult to manipulate because it involves only the cash and inflows and outflows out of the company. Rallis India's price was 82 times higher than its free cash flow, which in turn signifies that it had a very low free cash flow with it. Dhanuka's price was just 15 times higher than its free cash flow, and Meghmani's price was around 10 times higher than its free cash flow. These ratios signify where the price is compared to the different variables. Let us check the other valuation metrics. Price to book value or price to net worth compares what the company's shares value was as per the company's books and what valuation the market was giving to those shares. UPL's price to book was 3 times higher. Gujarat Alkalies price was trading at a discount to its book value. As I explained, book value is the value of the share as per the company's records, or this is what the company is saying its shares are worth. So we want to at least buy very near to what the company is saying its shares are worth. Then what the market participants are saying the share should be worth. Gujarat Alkalies shares have started trading below its book value. That is, we are getting it at a discount to what the company is saying the share is actually worth. Rallis India is trading 2 times higher than its book value. Dhanuka's shares are trading 3 times higher than its book value. And Meghmani's shares are trading at 1.6 times higher than its actual shares net worth or book value. Here we don't want the book price to book value to be more than 2.5 times. We want to buy as low as possible, provided other fundamental ratios are intact. Next, we'll look at the price to sales. This ratio measures the sales per share and compares the price with it. This ratio shows us where the price is compared to the sales. We can also view this in a big way by taking the entire market cap and looking at the sales and seeing what is the market cap compared to the sales. Here we see UPL price to sales was 2.2, which means that the price or the entire market value of the company was 2.2 times more than what the company has done as sales last year. Here we want the ratio to be as low as possible, because when the price is way too higher than what the company is doing it as, or company is selling its product, which shows weakness in the stock. People are valuing it at a much higher number or higher valuation than what the company is selling in the market. So the company's sales was, or you can say the company's price was 2.2 times higher than its sales. Gujarat Alkalies total entire market cap was 1.2 times higher than the sales. Rallis India's price was 1.4 times higher than the sales. Dhanuka's price was trading 2 times higher than the sales. Meghmani's market cap, entire value of the company, was even lower than its sales of the last year. This is what we are looking at a high discount value. Buying when the price, there's a mismatch of the price with fundamentals. To recap, the most fall was seen in Rallis India, Dhanuka Sugars, Dhanuka Agritech and Meghmani Organics. All of these have fallen more than 29% from their 52 weeks high. The least fall was seen in Gujarat Alkalies and UPL at 18% and 9%. In terms of earnings yield, that is how much the company earned per share, Gujarat Alkalies had the highest earnings yield of 17%, followed by Meghmani at 15%. So I have color coded this with this chart. The green represents the first highest point and blue represents the second highest score, whereas red indicates the least score or very expensive in this particular context. UPL's earnings yield was the lowest at 3%. That is, on a price of 943, it earned only 28 rupees. In terms of price to earnings, or where the price was compared to the earnings, UPL's price earning multiple was the highest at 33 times. The best or at most economical share price available to us was of Gujarat Alkali at 5 times. So investors were paying just 5 times more than the earnings of the company. Followed by Meghmani, which was available at just 6 times its earnings. When we look at the last year's price earning, UPL2 was very expensive at 23 times, and the lowest price earning multiple we were getting was for Gujarat Alkali, followed by Meghmani at 9 times. 5 years historical, we see Gujarat Alkali was trading at the lowest price earning multiple for both 5 and 3 years, whereas Meghmani again was trading at a very low price earning multiples of 9 times. The most expensive in 5 years and 3 years was Rallis India at 23 times and 22 times. In terms of price to OCF, we see Meghmani was available at just 4 times its cash earnings, whereas Gujarat Alkali was available at just 7 times. So these are good ratios. Rallis India was very expensive in terms of cash, available at 34 times its cash earnings. In terms of free cash flow, UPL was the most expensive along with Rallis at 82 times and 33 times its free cash flow. We want these ratios to be as low as possible. Both Meghmani and Gujarat Alkalies were available at a very decent price to free cash flow multiples. In terms of price to book value, Gujarat Alkali was available at a discount to its book value, whereas Meghmani was trading at just 1.6 times its book value. The most expensive here were Dhanuka Sugar, whose price was 3.2 times higher than its book value, along with UPL, whose price was 3.2 times higher than the book value. In terms of sale, UPL's market cap or market price was 2.2 times higher than its sales. Meghmani's price was lower than its sales, meaning it has done more sales than what it is valued in the market. Even Gujarat Alkali has done, its price or market cap is just 1.2 times higher than the sales. So it is very nearby to what it has done as sales in the last year. Next, let us analyze the profit growth rate of the last 5 years. This is the compounded growth in profit after tax over the last 5 years. This is a growth metric. UPL's profit since last 5 years has been growing at 22%. And if we look at the last 3 years growth rate, that too has been growing at around 22%. Gujarat Alkalies 5 years profit growth rate was 15%, and in the recent 3 years the profit has grown at a faster rate of 31%. Rallis India's profit has not grown at a very healthy rate in last 5 years, whereas in last 3 years the profit has grown at a slight percentage growth of 2.7%. Dhanuka's 5 years growth rate was 14%, but the recent 3 years we have seen a fall in the profit. Meghmani's profit growth rates were very high at 57% and 47%. After looking at these profit growths, we can use these profit growth rate ratios and use the price earning and compare both of them and look at how the price that we paid for the earnings, how is that earnings growing. So we look at by observing the PEG ratio, which is the comparison of price to earnings with the profit growth rate of 5 years and price to earnings of the latest 12 months with profit growth rate of last 3 years. These are valuation metric. They help us understand where the price is compared to certain variables. UPL's price earning growth ratio was 1.5 times, meaning the price earning we paid for UPL was 33 times the earnings, and the earnings was growing at the rate of 22% in the last 5 years. So we will assume that this will be the rate at which it will continue growing in the future years as well. So we get a PEG of around 1.5. This is the PEG that I am also looking at, and I want the PEG to be between 0 and less than 1.5 times. I want the PEG to be as near to 0 as possible, because that indicates that the price earning multiple that I have paid for the stock, that I will be able to recover much faster if the PEG is between 0 and 1.5. Anything above that would indicate that it will take me long or more years to recover the initial capital. Gujarat Alkalies PEGs were 0.3 and 0.1, which would indicate that the price earning multiple that I have paid for this company, there is a high profit growth rate in these companies. So if you look at the price earning, I just paid 5.6 times, but I got a profit growth rate of 15% in 5 years and 31% growth rate in the last 3 years. So I can expect to recover my capital or my invested money in per share faster. Rallis India's PEG for 5 years was very expensive. That is, the price earning to growth rate was very less. Here, if we see, the price earning was 18 times and the growth rate was not there. It was just 0.4%. That is why the PEG has turned up to 42. Dhanuka's is 1.2, and for the PEG of 3 years, that is in last 3 years, we see that the profit growth rate has dropped to 5.8%. That is why the PEG has increased to 3.2. We want, as I said earlier, we want it to be below 1.5 times. Rallis India's 3 years PEG was also above 1.5. So this is also already expensive. So when we see a PEG of more than 1.5, we should look for a price earning to be below 25 times and even below that too. So in this case, although we were paying 18 times, we are not getting that growth in the profit which is indicated by the PEG. So then we have to wait further for the PEG to fall below 1.5 times at least before we buy into the script. Meghmani's PEGs were very good at 0.1 and 0.14, which indicates that whatever price earning multiple we are paid, for that we are getting a high growth in profits. So if you look at this particular ratio, we paid 6 times the earnings and the earnings were growing at the rate of 57% since last 5 years, and profit was growing at the rate of 47% in the last 3 years. So this is the type of ratio we are interested in when we are looking for companies to buy into. Next, let us see how the sales have grown for these companies. Sales is a growth metric again. It is the compounded sales growth over a period of last 5 years, and the sales growth of last 3 years measures the growth in sales of the 3 years. UPL's sales has grown at 13% in 5 years and 12% in 3 years, last 3 years. So we want the sales to be growing at least 10% and above for every year. Gujarat Alkalies sales in last 5 years was growing at the rate of 6%, and in the last 3 years the growth has slightly increased to 8%, which is a good ratio to look at. Rallis also has managed to increase from 3% in 5 years to 9% in last 3 years. Dhanuka's sales has fallen from 10% growth rate over a period of 5 years to 7% in last 3 years. That is, the sales has moderated down. Meghmani's sales is almost same as it was for 5 years. So both 5 and 3 years are very nearby each other. To recap, UPL saw a 22% growth rate in profit, and Meghmani saw the highest growth rate in profit of 57% in 5 years, and in 3 years it was growing at the rate of 47%. Gujarat Alkali had the second highest profit growth rate of 31%. India has not done well for both profit growth and PEGs, as well as last 5 years growth in sales. Even Dhanuka Agritech in last 3 years has grown its profit at just 5.8%. PEG wise, we already saw for 5 years. In 3 years, both Rallis India and Dhanuka are very expensive. Sales wise, Gujarat Alkali has managed to grow its sales by just 6 and 8% over a period of 5 and 3 years, which is low, whereas Meghmani and UPL have done highest profit sales growth rates. At the end of the video, will be segregating all these ratios into 6 types, which is efficiency, solvency, cash flow metrics, growth metrics, return metrics, and valuation metrics. These ratios will help us understand which companies have performed well in which metrics or in which group. I'll explain later on when we come here finally what or which ratios are included in the efficiency metric, which are included in the solvency, and so on. For time being, let us continue our analysis of return on equity of the last 5 years on average. This is a return ratio and it measures what profit the company has generated over a period of last 5 years on equity shareholders' money. UPL has generated 25% return on shareholders' money. Even in recent years, it was around 25%. So for both average as well as 5 years and even the recent RoE was around 25%. We want the ratio to be at least above 15%. Gujarat Alkalies RoE average as well as recent years RoE was below 15%, and although the recent RoE is above the average, it's still below 15%. Rallis India has on an average earned a return of 16% on equity, whereas in the recent last year it has fallen to 12%. Dhanuka's return on equity is high at 25 and 21% for 5 years average and the recent RoE. Meghmani has an average of 13% RoE, whereas in the last year it has earned a 21% return. Let us look at the growth in equity or return on equity, how it has grown over a period of 5 years. This is a growth metric. UPL's equity or return on equity has grown at the rate of 7%. We want a growth rate. It does not matter what is the level of growth, but we want to see some kind of positive growth rate. Gujarat Alkalies return on equity has been falling from last 5 years at the rate of 0.68%, very mild degrowth. Rallis India's return on equity has been falling at a very steep pace of 11% over a period of 5 years. Dhanuka's RoE has been falling at the rate of 3.92%, and Meghmani has grown its return on equity at a phenomenal rate of 42%. Next, let us look at the return on capital employed. This is the average return on capital employed over the last 5 years. And capital employed is basically calculated by dividing the EBIT by annual average capital employed. Now what is capital employed? In this case it is fixed assets, which also includes the depreciation and the working capital, which is basically calculated by removing out current liabilities from current assets. So if you're not familiar with these terms, you would have to at least Google it out and try to find out what working capital actually means and what is capital employed, what is fixed assets, and so on. These are return ratios. They measure what is the profits that the company has earned on certain variables like capital employed, fixed assets, and so on. RoCE also we want it to be above 15% for both 5 years average as well as the recent year. UPL has done well to give an RoCE of above 15%. Gujarat Alkalies' recent RoCE has improved to 18%, and on average it was having an RoCE of 12%. Rallis India's RoCEs were above 15%. Same was the case for Dhanuka Sugar as well as Meghmani. Let us look at return on assets. This is the profit generated on the assets that was employed into the business. Here assets employed is basically the total assets of the company, and we remove out current liabilities from that. This is again a return ratio. UPL's RoA was 11%. We want RoA to be also as high as possible. There is no fixed percentage rate here. Gujarat Alkalies RoA was 9%, and Rallis and Dhanuka have managed high RoAs of 14 and 23%. Meghmani's return on assets was low at 6.2. This basically would make us understand how the company is how well the company is managing its assets and what is the return it's generating on the assets. Next, let us check the asset turnover. This ratio is measured by dividing the annual sales with the annual assets. So basically what we understand from this is how many times over the assets have been converted into sales in 1 year. Here assets means net worth plus the borrowings. So for each ratio the investor has to understand what that ratio is composed of, or what are the variables used to calculate that ratio. Here too we want it to be as high as possible. That is, the sales has to be a certain multiple of the assets. So we want the sales to be, let's say, 5 times more than the total assets employed into the business. This is an efficiency ratio. It measures how efficiently the business is converting its assets or the total value of the assets into sales. UPL is last year converted 1.1 times more than the assets that it held. Gujarat Alkalies sales fell below the assets that was deployed into the business. So here we want it to be as high as possible. All three, Rallis, Dhanuka and Meghmani, have managed to turn over more than 1 times its assets. Next, let us check the return on invested capital. This is calculated by dividing the operating profit by the invested capital. Now let us understand what is invested capital. It consists of net block, meaning the fixed assets less depreciation is the net block, and we also add the working capital, and working capital I have already explained is calculated by removing current liabilities from the current assets. This ratio measures the return from the core business of the company. This is again a return ratio. UPL, we also want this to be as high as possible. All these companies have managed more than 20%, about 20% growth rate in their invested capital. Okay, let us understand how the companies have done in terms of earning profit on different variables. In terms of average return on equity, both UPL and Dhanuka Sugars have done the best. Gujarat Alkalies RoE was the least at 10%. The recent year RoE was again best for both UPL and Dhanuka Agritech, whereas Gujarat Alkali and Rallis India performed poorly in earning profits for the equity shareholders. In terms of growth rate in equity or return on equity, we saw that UPL and Meghmani have done the best of having a positive growth rate in their return on equity, whereas all the three companies like Gujarat, Rallis and Dhanuka had seen their RoE falling from 5 years back. In terms of return on capital employed, UPL and Dhanuka have done well by giving a returns of 22 and 32% on the total capital employed over a period of 5 years. Gujarat Alkali has done poorly by having a RoCE of just 12%. In terms of last year's RoCE, Rallis India performed poorly while Dhanuka and Meghmani have done well by giving a RoCE of 28 and 30% each. In terms of return on asset, we saw that both Rallis and Dhanuka has performed well of giving a high returns of 14 and 23%. Meghmani had a low returns of 6%. In terms of turning over assets into sales, Gujarat Alkali has not managed to give a high sales against the assets that were employed into the business. Both Rallis and Dhanuka have done better at turning over the assets. In terms of return on invested capital, both Dhanuka and Meghmani have done well. Rallis had a low return of 21% on its invested capital. Next, let us look at how the companies have converted their earnings into cash and how much of that cash was used up in buying of fixed assets, and out of that finally what was left over as free cash flow. These comparisons we'll look at by using the CFO to PAT and FCF to CFO. Let me explain all these ratios one at a time first. The PAT 5 years calculates the sum of all the profits after tax of the last 5 years. The cash flow from operations calculates the cash earned through operating activities over a period of last 5 years. And the free cash flow is the cash that is still lying around with the company after investing in fixed assets from the cash that it earned through the operating activities. So the free cash flow is basically calculated by subtracting the fixed assets purchased from the cash earned through operating activities. And we also add back if some assets are sold by the company over a period of last 5 years. So this is the analysis of how the company has done in terms of converting its earnings into cash over a period of 5 years. So this ratios gives us a big picture of the company's working. Now, as far as criteria is concerned, I'm looking at the companies converting the entire earnings that they have shown as profit after tax to be converted into cash. In last 5 years, UPL has earned a profit of 6,900 and it has received a cash of 9,600. That is, it has converted all of its profit into cash and the company has more cash coming in by way of, say, depreciation or by way of non-cash expenditures getting added back in the cash flow statement. I would encourage all investors to study the cash flow statement. It's a very important statement to understand. It's more important than the earnings figure that is mostly used by all analysts or even the media companies or TV channels which show earnings instead of cash, which is less difficult to manipulate than the earnings figure. And out of the cash that the company earned of 9,600, it still had 5,200 left over as free cash. This is the values that we would want to see. That is, the cash coming in through operations has to be more than the profit after tax, and the free cash flow should be more than 50% of the cash from operations. That is, not more than 50% of the CFO should be used up in buying of fixed assets. This is my criteria. Investors can change as per the risk that they want to take into the company. So these ratios, CFO to PAT, tells us that the cash was 38% more than the earnings of the company. We want a positive figure and as high as possible. That is, the company should be receiving more cash than what they have earned as profit after tax, because the profits is calculated by removing all cash as well as non-cash expenditures. Whereas what happens is in non-cash expenditure, there is no cash going out of the business, but in P&L account, the non-cash items are also considered to come to the net earnings figure. The free cash flow was 45%. That is, out of 9,600, 5,200 was left over and the balance was used up in buying of fixed assets. So we want the companies to invest in fixed assets, but at a reasonable level of what they are earning as cash from the operations. Whenever companies start investing more than what they have earned in cash, that's a sign of a red flag. Because in this case, then the companies would have to borrow more and more from the banks, on which they have to pay more interest, and then that would definitely reduce the profits for the shareholders. So these ratios, PAT and CFO, are good for UPL. Let us analyze Gujarat Alkalies. Profit was 1,400 and the cash coming in was 1,700. Again a good value, and it was 22%, that is cash was 22% above the earnings. And the company has used up 63% of the cash into buying of fixed assets. This has gone slightly above 50%, but we can ignore this for time being. Rallis India had cash 3% more than the earnings. Out of 801 shown as earnings, 829 came in as cash and 566 was still left over. That is only 31% of 829 CR was used up in buying of fixed assets. This is also good. Let us look at Dhanuka. Dhanuka's PAT was 548 and the company's cash was less than the PAT. So we don't want these kind of values to be seen in our PAT to cash flow analysis. Out of 484 CR earned through cash, 377 was still left over as free cash flow. This is okay, but when we see less cash coming in against the profit of the company, that at that time we have to be a little bit alert. So we see here that the cash coming in was 11% less than the earnings of the company or the profits of the company, whereas it had utilized 22% in buying of fixed assets and the balance was still left with the company. Meghmani's cash was 192% more than the earnings. So its earnings were 427 CR, whereas its cash was 1200 CR, which is 1.9 times higher, almost 2 times higher than its earnings. And it has also managed to keep most of its cash as free cash in the business. So it has utilized 42% in the business operations. So in terms of free cash flow, UPL and Meghmani both have converted a high percentage of their earnings into cash. Dhanuka Agritech fell short by 11% in terms of converting its earnings into cash. In terms of free cash flow, the maximum investment into buying of fixed assets was done by Gujarat Alkalies at 63% of its cash from operations, and we saw that Rallis India and Dhanuka both have managed to invest, but at only 22 and 31% of their cash from operations. Next, let us look at 1 year average PAT and how that profit of last year was converted into cash. Then we will compare the current year's profit and understand how it has grown above the 5 years average and how the profit has grown over the previous year's profit, and finally how much of that profit of last year was converted into cash. UPL's on average has been earning 1300 CR as profit, whereas in the last year its profit was 1600, that is above the 5 years average, which is a good sign, and it was below the previous year's profit of 2000 CR. So we see that it was above the average but below the previous year. So it was above the average by 20%, but there was a degrowth in YOY profit of 19%. The profit fell by 19% from its previous year's profit. So we want the profit growth year on year to be positive and at least 10%, and wherein if you have to understand about the PAT of 12 months with the average, then it has to be just above the average. There is no set criteria for how much this year's profit should be above the average. What we are interested in is that it should be above the average. In terms of converting its profit into cash, we see that here too it has converted 36% above what it earned as earnings from the business. So last year it earned 2000 CR and it received a cash of 2800, which was 36% more. CFO to PAT is a cash flow ratio or cash flow metric, whereas profit growth YOY is the growth metric. Even the profit after tax over the 5 years average is a growth metric. Gujarat Alkalies profit of the recent year increased by 140% above the average of 5 years, and its profit from its previous year has grown by 37%. It had 2% more cash coming in against the earnings. So all these ratios are very good for the Gujarat Alkali company. Rallis India's profit had fallen 3% below its average. So we don't want to see a negative value here. It shows weakness in the company. Its profit, since the profits for both the last year and the current year is the same, I have edited the numbers. Previous year's profit was 168 CR and the current 12 months, that is 2019, profit was 155 CR. So we see a profit fall of 7% from the preceding year. In terms of cash too, we see Rallis India fell short by 48% in converting earnings into cash. So we see here the profit that the company showed was 168 CR, but the cash coming in was just 80 CR, which is a 48% drop from the earnings that the company has shown. We don't want to look at this kind of values where the profit over previous year is falling, the profit is below the 5 years average, and cash has not come in against the earnings of the company. So all these three ratios are in red. Dhanuka's profit has grown by 2.5% above its 5 years average, but from its previous year it has fallen by 10%, and it has received 10% more cash than the earnings. So this ratio is okay, but these two are, even this is okay, just the profit growth rate from the previous year has fallen by 10%. Meghmani's profit has increased by 207% above its average, which is the highest in the group. Even when we compare it with its previous year, it has increased YOY by 52%, and it has managed to convert entire profit into cash by 135%. So this is the good metric for Meghmani. Gujarat Alkali and Meghmani both have managed to increase their recent profit by more than 100% above its 5 years average. Rallis India's profit fell below its 5 years average. In terms of YOY growth rate in profit, both Gujarat and Meghmani have done well by growing their profits at 37% and 52% over its previous years. Rest all the three companies, Dhanuka, Rallis and UPL, have seen their profits falling 19%, 7% and 10%. In terms of converting earnings into cash, both UPL and Meghmani have done well by converting most of its earnings into profits or profits into cash, whereas Rallis India fell short by 48%. Its cash coming in was way too less than what it earned as profit. Next, we'll look at the quarterly analysis of sales and profit, how the sales have grown over YOY period, that is year on year, for example, March 2018 quarter with March 2019 quarter. Then we'll look at Q over Q growth rate, that is December quarter over March quarter. Same with the profit growth rates. All these are growth metrics. UPL has managed to grow its sales YOY by 49%, but its profit fell by 57%. In terms of Q over Q, it managed to grow its sales by 73%, but again profit fell by 55%. So this is not a good sign. We want the sales to grow as well as the profit to grow above 10%. Gujarat Alkalies sales increased by 17% YOY, but the profit again fell by 23%. Q over Q, it managed to increase its sales a bit, but the profit also was showed a mild increase of 4.6%. Rallis sales had a fall of 8% over YOY, and the profit fell by 92%, which is absolutely not a good sign. Quarter on quarter also we see that sales have fallen by 18% and profit has fallen by 89%. So in the recent quarters, Rallis has not done well, both in terms of sales as well as in terms of growing its profit. Dhanuka's sales YOY increased by 4% and its profit fell by 6%. Whereas if you look at quarter on quarter, it increased by, sales fell by 11%, but the profit increased by 83%. Whenever we see such high growth rates in profit, we have to understand what is the base value that we are looking at. Meghmani's YOY profit sales has increased by 18% and even profit increased by 53%. So all these are positive values for Meghmani. Both UPL and Meghmani have managed to grow their sales at double digits, and Rallis India's sales over YOY had a negative fall in its sales growth. Q over Q also, Rallis India saw a high fall in its sales from its previous quarter of 18%, whereas only UPL managed a high growth over quarter on quarter. UPL had the highest fall in its profit of 57% YOY and 55% QOQ. Rallis India also had a very high fall in its profits. For 5 years, for YOY, Meghmani had a good profit growth rate of 53%, whereas quarter on quarter, Dhanuka had a good profit growth of 83%. Next, let's check out how big the companies are in terms of net worth. Net worth is basically the book value of the company, and it is calculated after deducting all liabilities that the company has by selling all assets. UPL's net worth was 14,645 CR, and other companies like Gujarat and Rallis India were more than 1,000 CR companies. This is a growth metric, and we have to look at the contingent liability, that is those liabilities which may or may not arise in the future and for which the company has not made provisions. So we don't want the contingent liability to be more than 20% of the net worth. So we have this ratio, contingent liability to net worth, which will measure whether the company's contingent liability is exceeding 20%. When we look at all the companies, none of the companies have exceeded 20% of their contingent liability in respect of net worth. Gujarat Alkalies had the highest contingent liability of 18%. So of the net worth of 4,200 CR, the contingent liability stood at 807 CR. Next, let us analyze the debt to equity ratio. This is the total borrowings the company has done against what the equity shareholders have contributed. So we don't want the debt to be more than one times of equity, meaning even if the debt to equity is same, it's okay, but the debt should not exceed what is contributed by the equity shareholders. Whenever the debt or the borrowing increases beyond a certain ratio, it would indicate that the company will have to pay borrowing cost on it or a finance cost on it, which is the interest, which would eventually reduce the profit of the company. So we don't want the companies to borrow in disproportionate manner. UPL's debt was very high at 1.97 times its equity contribution. All other companies have managed to keep their debt to equity ratio below 1 times. Let us next look at the interest coverage. This ratio compares the EBIT or the earnings before interest and tax, and we divide that by the interest expense. So then we come to know for how many more years can the current EBIT pay future years' interest payments. This is an efficiency ratio. UPL's this year's earnings before interest and tax can pay next 3 years of interest payments. Or we can also say that the earnings or the operating profit is 3.2 times higher than what the company paid as interest cost this year. Gujarat Alkalies interest coverage is very high at 49 years, or we can say that the interest cost or the operating profit for that matter was 49 times higher than the company's interest payments. This is because the interest payments were very low, because the company has very low debt or borrowings. Rallis India also managed to keep its interest coverage at a very high 28 times or 28 years. Most of these companies, since they had a very less debt to borrowings ratio, their coverage is also high, and this is what we also want to look at. Meghmani had 8 times more profit or operating profit than what it paid as interest cost in the last year. Although it had a high debt of 0.65 times, its coverage was still good. Next, let us look at the debt to profit. This ratio tells us where the borrowings is, or how much more the borrowings is compared to this year's profit. This is an efficiency ratio. UPL's borrowings were 14 times more than this year's profit. Or if we have to say it in another way, if we consider this year's profit at this rate, the company will take 14 years to pay off the entire debt that the company has. We don't want the debt to profit ratio to be very high. Even in case of interest coverage, we want it to be more than 4 times at least, meaning the operating profit is at least 4 times more than the interest the company has paid. Most of these companies' debts were easily coverable by the profit of this year itself. Meghmani had 3 times more borrowings than this year's profit. This is also very reasonable. Next, let us look at change in promoter holding from 3 years back. UPL's promoters holding have decreased by 1.85%, which is very marginal, and Meghmani's have decreased by 2.41%. This is also very reasonable. We don't want a very high drop in promoter holding from where it was 3 years back. The other 3 companies had no change in their promoters holding. Let us look at the current promoter holding of these companies. This is again a solvency ratio which helps us to understand how solvent the company is or how safe the company is. We want the promoter holding to be more than 30% at least, which shows that promoters have high stake in the company and they will work for growth of the company. Gujarat Alkali had 46% promoter holding, and the highest promoter holding was seen in Dhanuka Agritech at 75%. Next, we'll look at the pledge shares. This is the pledge of the shares that the promoters have done with banks on their holdings. So we don't want the pledge to be more than 20% of the promoter's holding. That is, promoters should not pledge their shares to the banks exceeding 20% of their holdings. We see none of these companies have pledged their shares. The pledge is very important to understand because when the company starts pledging their shares or putting their shares and taking loan against that from the banks, and if they don't clear off that pledge, then the banks would most likely sell it in the open market, which would directly affect the price of the stock. So to recap, UPL was the highest net worth company at 14,000 CR and Dhanuka was a very small company at 642 CR. In terms of contingent liability, UPL had the least contingent liability as well as Dhanuka. Gujarat Alkali had the highest at 18%. Debt to equity, Dhanuka was the lowest along with Gujarat Alkali. Both had good coverage ratios of 49 years and 172 years, or in other words 49 times more was the EBIT than the interest cost. The debt to profit also was very low at 0.35 times, meaning the profit can easily pay off the borrowings that the company had. That is, the borrowings were just 35% of its this year's profit. Dhanuka's debt to profit was also very low. UPL's borrowings were very high against this year's profit at 14 times borrowings were more than the profit. In terms of promoter holding, highest was seen in Dhanuka as well as Rallis, and UPL had the lowest promoter holding. Pledge wise, none of the companies have pledged their shares. Next, let us check the other ratios. Here we are looking at debtors to sales percentage, which shows how much money was still pending to be collected from the customers against this year's sales. We don't want the payments to be collected to exceed 30% of this year's sales. UPL collection from customers was 54% of this year's sales, which was very high. Rest all the companies have managed to stay below 30%. So we don't want the collection to exceed 30% of this year's sales. Let us look at how the companies are collecting payment from customers, that is, within how many days the company is giving credit to its customers. UPL's collection days are very high at 127 days. My criteria is less than 90 days or 3 months. That is, within 3 months the customers have to pay back to the company, or we can also say that the company has to collect payment from its customers within 90 days. All other companies are collecting within 90 days. Let us look at how it was collecting money from the customers 3 years back. So that gives us an idea as to how it was 3 years back and how the company is doing now. 3 years back it was 114 days for UPL, which was even higher 3 years back, and today it is even higher than that at 127 days. So we want the debtor days or collection days to fall rather than increase. Gujarat Alkalies collection days have increased by additional 2 days, which is reasonable. Rallis India's collection days have gone up quite substantially from 54 to 82. Dhanuka has managed to reduce the current debtor days from 90 to 78, which is a good sign. Similar is the case for Meghmani from 89 to 75. So we want the collection days to fall and we want the collection days to be also less than 90 days. Next, let us look at the inventory turnover. This is the measurement of how many times more was inventory turned over into sales. UPL sales were 4 times more than its inventory holding of this year. So we want the sales to be as high as possible than whatever inventory it is holding. Gujarat Alkali inventory was 11 times, or sales rather was 11 times more than the inventory. Rallis India was 3 times, Dhanuka 4 times, and Meghmani managed to turn over its inventory or convert its inventory 7 times more into sales. Let us look at how the company was turning over its inventory 3 years back. UPL was almost very similar to where it is right now at 4 times. Same was the case for all the other companies. This helps us to understand how well the company is managing its inventory holding and how fast it is converting its inventory into sales. Next, let us look at the 5 years operating profit margin. This is the average OPM that the company has been earning over a last 5 years period. This helps us to understand how well the company is managing its expenses against the revenue that it earns through sales. This is an efficiency ratio, or in fact it is a return ratio, that is on sales. What is the margin that the company has after deducting the operating expenses? We want the OPM to be at least 15% and above. That suggests that the company can easily pay off the interest cost, the depreciation, taxes, and any extraordinary item which may pop out in the future. So we want at least a 15% of OPM on average. Gujarat Alkali also had a 21% OPM, which was very nice. Rallis India was very near to 15% at 14.7%. Dhanuka was 17% and Meghmani was 19% OPM. So most of these companies have managed to keep their OPM above 15% except Rallis India. In terms of NPM, last year, we want the NPM to be at least, or net profit margin for the company to be at least 10% and above. Because if the company is doing sales, we should expect it to earn at least 10% on that. UPL is earning 11%. Both Rallis and Meghmani last year had a NPM of less than 10%. Let us look at the NPM which these companies earned in the preceding year. Most of these companies had a double-digit growth rate in their NPM, except Rallis and Meghmani. Both have managed to earn less than 10% on their sales, which is not a good sign. Next, let us look at the solvency ratios, quick ratio and current ratio. These are liquidity ratios which measures how well the company can pay off its current liability by using its current assets. And in quick ratio, it's the same thing except it having current assets, it would have quick assets like cash, bank FDs and so on. So we want these ratios to be at least 1 or above that. Anything below that is investors would need to inquire as to why the assets are not enough to cover the current liabilities. All of these companies had good current ratios of above 1. In terms of quick ratio, both Rallis and Meghmani fell short of 1 times. To recap, Gujarat Alkali had the lowest debtors to sales ratio, which is very good, and UPL had the highest, which is of some concern. Debtor days, that is collection from customers, was also very high at 127 days. Gujarat Alkali was the best, collecting within 59 days. UPL 3 years back also was giving its customers 114 days to pay back to the company. Gujarat Alkali and Rallis were collecting within 54 days 3 years back. Although for Rallis India in the recent year, the collection days have gone up high. Both Gujarat Alkali and Meghmani had a high 5 years OPM margin, whereas Rallis India had the lowest at 14.79%, and it had also fallen below 15% of our benchmark. Next is the net profit margin. Again, Gujarat Alkali and in this case Dhanuka has earned the highest NPM last year of 21% and 13% each. Both Rallis and Meghmani had a very low NPM, so that needs to be investigated. Over preceding years NPM also, Gujarat Alkali and Dhanuka both have done well of having an NPM of above 10%, whereas Rallis and Meghmani again, even in the preceding year to that, 2 years back also, their NPM was below 10%. In terms of current ratio, Gujarat Alkali and Dhanuka had the highest coverage in terms of clearing of their liabilities. Meghmani had a low current ratio, but it was even better since it is above 1 times. In terms of quick ratio, both Rallis and Meghmani fell below 1 times, meaning their current quick assets are not enough to cover up the current liabilities. Gujarat Alkali had the highest quick assets to cover up the current liabilities. Even Dhanuka had a good coverage in terms of quick ratio. Next, let us look at the gross block, that is the total assets that the company has at their acquisition cost. And then we'll look at the accumulated depreciation on this gross block and what is the final net assets that the company has after deducting the depreciation over the gross block, and what is the depreciation rate charged on this net block. So to cover this up, we have two ratios where we compare how much of the gross block has been already depreciated, so that we can understand how much of the assets are still required to be depreciated in terms of percentage terms, and what is the rate at which they are depreciating every year. So we don't want a very high variation between different companies. So whenever we see a wide gap between these companies depreciating their assets, that's a kind of a thing which needs to be investigated. Why one company would depreciate their assets at a very high rate and or depreciate at a very low rate compared to the peer group companies. UPL's accumulated depreciation is 60%, meaning only 40% of the assets are still to be depreciated. Gujarat Alkalies assets have been depreciated only up till 3% of its gross block. That is, of the 2,171 CR of assets that the company had, till date only 67 have got accumulated. That is, depreciation of 67 CR has got accumulated. Now the company has an additional net block of 2,300 CR. Generally, we should see a lower net block, but in case the companies have added additional assets after depreciation, then we will see an increased value in the net block. Just like in UPL, the gross block was 11,000 CR and the accumulated depreciation was 6,700 CR. So we should have seen somewhere around 5,000 CR of net block. But instead we are seeing 32,000 CR of additional assets adding into the company. So here the company has acquired more assets in the last year, because of which the net block has increased now. And the company is charging just 2% as depreciation on this net block. Gujarat Alkali is charging 5% on its net block of 2,300. It charged a depreciation of 127 CR, meaning whatever assets it had, it has reduced those assets by 3% on an average last year. We don't want a very high depreciation rate. If the company is depreciating its assets at a very high rate, that would reduce the net profit of the company, and if they are slowing down their depreciation rate, that would inflate the profit. So we want a balance of the two. And its depreciation rate is 5% and its total accumulated depreciation on the gross block was 3% only. So balance 97% is still to be depreciated over a number of years. Rallis India's accumulated depreciation was 23%, so balance was still to be depreciated, and it's charging 7% on the net block. Dhanuka's accumulated depreciation was 18% and it is charging 12% on its net block. Both Meghmani is also charging at 12%. So if the company, let's say, is charging 10% depreciation rate every year, that would mean within 10 years those assets books, until and unless some more new assets are being added continuously. So we have to understand that the companies don't depreciate their assets at a very high rate or rate, as I explained earlier. In terms of dividend yield, the highest dividend yield was paid by Rallis India at 1.72% on the current price. This is the dividend that the company pays to the shareholders for the risk that they take in investing into the companies. It's like an additional bonus for the shareholders. But as investors, we should not rely upon dividend yield alone for our investment decisions. This concludes the analysis of these companies. To conclude the analysis, Meghmani has got the highest score of 186, followed by Gujarat Alkali at 181 points and Dhanuka at 168 points. The fourth highest was UPL at 139 and Rallis India got the lowest points at 112. Now what I have done is we have divided these ratios into 6 parts. One is efficiency ratio, solvency ratio, cash flow metrics, growth metrics, return metrics and valuation metrics. I'll explain what each of these ratios or metrics cover which ratios. So let us look at efficiency first. The efficiency ratio is how well the company is managing its gross block, how fast it is clearing of its gross blocks. Also, what is the depreciation rate it is charging on the net block. So we want it to be as high as possible, but not very high. But in the group company, whichever is the highest, they are depreciating their assets at the highest rate, so their net profit will also be the lowest. Then efficiency ratio also includes the inventory turnover, which measures how well the company is converting its inventory into sales, or how many times more in a year the inventory is getting turned over into sales. How fast the company is collecting payment from its debtors is also included in the efficiency ratio. In last 3 years back as well as currently, how fast it is collecting payment from the customers. Efficiency also means how much the company is still to be collecting from its customers against this year's sales. So we want this to be below 30% of the sales. So if the companies accounts receivables or debtors exceed 30%, it would get a lower score. Efficiency also includes debt to profit, which measures where the debt is compared to the profit of the company. How fast can the company clear off its borrowings using the current year's profit? How many more years would it take if we consider the current profit to be the base profit, and if we continue like this, how many more years would it take for the company to clear off its borrowings? Interest coverage is also an efficiency ratio which measures the interest part compared to the operating profit. We also look at debt to equity as an efficiency ratio which shows how well the company is managing its debt against the equity contribution of the shareholders. I have also included contingent liability compared with its net worth in the efficiency ratio because it also measures how well the company has managed to keep its contingent liability as low as possible against the net worth of the company. And finally, we also have asset turnover, which calculates how well the company has managed to turn over its assets into sales. This all ratios are included in the efficiency ratio. Next, let us check the solvency ratio. Solvency ratios are the current ratios and quick ratios, which measures how fast the company can clear off its current liabilities. The pledge part, the promoter holding, which is very important because it shows what is the promoter's stake in the business, and if they are pledged a very high percentage, it creates a problem for the company's solvency. It basically turns it into a risky proposition if there is a high pledge. So there are only 5 ratios which are included in the solvency ratio. Next, let us check at the cash flow metrics, which is also very important. In the cash flow metric, we look at how much of the earnings has got converted into cash in 5 years as well as in the annual calculations. So we have the cash flow from PAT of 5 years as well as cash flow to PAT of the single year. We also include in this the free cash flow to the cash flow from operations, meaning how much of the cash that the company has earned, how much of that has got converted or how much of that has been used up in buying of fixed assets, and finally how much is left over as balance free cash flow. So this helps us understand what the company can use in the financing activity like buyback, bonus and so on, acquisition. Next, let us look at what ratios are included in the growth matrix. The growth matrix looks at the net worth of the company, how big the company is, the quarter-on-quarter profit growth rate as well as sales growth rate, how fast the company is growing its sales and profit in the quarter. It also looks at the profit growth rate YOY, what is the growth compared to its previous year in net profit. Also, it looks at how well the company has managed to grow its profit, current year's profit, above the average or below the average. We also include the return on equity of the 5 years, whether the company has been able to grow its RoE over a period of 5 years. Then we have the sales growth rate of last 3 years, sales growth rate of 5 years in this calculation. We also include the profit growths of both 5 years and 3 years. That is, how has the profit grown from 5 years back or even 3 years back. All these ratios are included in the growth rate. Next, we'll look at return metrics. Return metrics calculates what is the return the company has generated on different variables, like how much the company has paid as dividend based on the price. We also have net profit margin, that is how much the company earned on the sales. And then we have the 5 years OPM, which indicates what was the margin, the top line margin after removing the operating expenses only. What is the margin that the company has been earning? Then we have ROIC, which is the invested capital, which would include our net block, that is assets less depreciation, and the working capital. We have also included RoA, return on assets, what is the profit that the company is earning on assets. Assets, as I mentioned earlier, is the total assets less current liabilities. Then we have capital employed, return on capital employed, which is the total assets, that is fixed assets plus the working capital. So these are the different return ratios which have been added, like RoCE, ROE of 5 years, ROE of 1 year. Then earning yield, that is on the share price, how much was the profit that the company has earned per share. So all these ratios have been added in the ROE return metrics. And finally, the valuation metric, which shows us where the price is compared to different variables, which helps us understand whether this is the right time to buy into the company. So we have metrics like PEGs, which help us understand whether the price earning multiple we paid is that justified. Then we have price to sales to understand what is the sales the company is doing and how much is its total market capitalization. So if it's very nearby, if the price is very near to the sales or its market cap is very near to the sales, it generally indicates that it is a very good value buy. Then we have price to book value, price to free cash flow, price to operating cash flow. Then we will also look at 3 years historical price earning, 5 years historical price earning. What was the price earning last year? What is the current price earning? And what is the percentage fall from its 52 weeks high? All these ratios indicate to us the valuation that the stock is demanding and whether we are buying it at reasonable valuations or not. So we have a total score of 139 for UPL. So I've arranged these ratios in of their significance for me. For me, efficiency in the business is very important, along with solvency and cash flow. Returns is not a very high priority unless cash flow is good. All the metrics are very important to look at. Let us begin with the efficiency metric. The best score was for Dhanuka Agritech, which scored 45 points in its efficiency metrics, followed by Gujarat Alkalies at 41 points. The worst efficiency was seen in UPL, where the business, in terms of efficiently managing its sales or its assets, was not seen. In terms of solvency also, UPL was seen at the lowest metrics, whereas Dhanuka and Gujarat Alkalies again scored the highest at 16 and 13 points. Even Meghmani in terms of solvency was not very good. It just received 8 points, very similar to UPL. In terms of cash flow, which is again very important, UPL has done very well in converting its cash, or its earnings rather, into cash. Gujarat Alkalies' cash conversion was not good at all. It received just 6 points and the lowest score. Meghmani also has converted a good amount of its profit into cash. So these 3 top metrics together should score a very good point for the company. In terms of growth in their sales and profit, we see that UPL has grown its sales and profits at a high pace, along with Meghmani at 51 points. Rallis India seems to have done very poor in terms of growing its sales and profits. In terms of returning metrics or return metrics, that is RoE, RoCE and so on, both UPL and Dhanuka have done well at 43 and 35 points. Rallis India again did very poor at just 25 points. Its return metrics were very poor. In terms of valuation or how cheap the stock is, UPL seemed to be very expensive, and both Gujarat Alkali at 49 points and Meghmani at 46 points seems to be the cheapest of the stock of the group. Even Rallis India was very expensive and got the lowest score of 20. So finally, when we conclude this analysis, I see that Dhanuka along with Meghmani and Gujarat Alkali are the top 3 scrips that we can think about investing in the current scenario. Thank you for watching this video.